Hello everyone, this is Madhvi Mehta from Kotak Securities Commodity Research Team and I welcome you all to another session of Commodity Catch-up where we'll discuss major market developments as well as price outlook for major non-agriculture commodities. Commodities ended a volatile week on a mixed note, reflecting increasing uncertainty in the market. Gold and silver ended lower thanks to a late week sell-off. Industrial metals were mixed as growth worries were countered by supply concerns and China's stimulus measures. Crude oil ended higher, while natural gas noted marginal losses. Financial markets were volatile throughout the week as market players positioned themselves for the key event, which was Fed Chairman's comments at the annual Central Bank Summit in Jackson Hole. Market players debated if Fed Chairman may maintain a hawkish stance with inflation out of control or may take a less aggressive approach in lieu of increasing challenges for the economy. There was no major change in Fed Chairman's stance, however, it was enough to result in a late week sell-off in equities and commodities and a marginal rise in the US dollar. The Fed Chairman reaffirmed the need for continuing with rate hikes to get inflation under control. Powell said that the economy needs tight policy for some time before inflation is under control. A number of other Fed officials also reaffirmed the need for continuing with rate hikes. Comments from Fed officials, including Fed Chairman Jerome Powell, indicate that the central bank may continue with rate hikes unless there are clear signs that the inflation situation is improving. The pace of rate hikes may, however, remain open for debate and market players may continue to react to economic numbers and central bank comments. Data released last week was mixed. However, consumer sentiment data showed some signs of hope. Consumer sentiment rose to a 3-month high, while near-term inflation expectations fell to an 8-month low. While Fed expectation and the US dollar affected commodities, we saw some choppiness also as market players assess the outlook for Chinese economy in light of increasing stimulus measures. Outlook for Chinese economy has worsened amid disappointing economic data, virus-related restrictions, stress in the property market, and the ongoing power crisis. Amid increasing pressure on the economy, the government has intensified efforts to boost economic growth. After cutting key lending rates to improve liquidity, the Chinese State Council announced a 19-point policy package targeting the infrastructure sector. At the same time, the State Council stated that the economy would not be flooded with massive stimulus checks. China's measures lent some support to commodities but failed to improve market outlook significantly. Chinese equities ended lower for a second consecutive week, while the Chinese yuan tested the lowest level since August 2020 against the US dollar. Some commodities also benefited from supply risk relating to Europe and China. The ongoing power crisis is hampering economic activity, including production activity, and this has benefited some commodities like aluminium and zinc. Crude oil has also benefited from expectation of increased fuel switching. European natural gas prices surged to March highs last week, while power prices jumped to a record high level as Russia announced that it will completely shut the flow on Nord Stream pipeline for 3 days from August 31st to September 2nd. Adding to it, British energy regulator lifted electricity price cap by 80%. We may see volatility continuing with focus on Fed's monetary policy stance, China's economic health, and power crisis in Europe and China. The key event for the coming week is US non-farm payrolls report, which will reflect upon the health of US labor market. Market expectations are running high that Fed may continue with rate hikes, and the labor data may help form expectation for Fed's next move in the month of September. Market expectations show that the jobs growth slowed down marginally last month. Let us now talk about individual commodities. We'll start with bullion. Gold and silver witnessed mixed trade but ended lower owing to a late week sell-off weighed down by Fed's hawkish stance and continuing ETF outflows. However, supporting prices were global growth worries, persisting inflation concerns, and increasing geopolitical tensions. Going ahead, gold may waver amid mixed factors and as market players react to economic data and central bank comments. However, the general bias may be on the downside as Fed's hawkish stance may keep the US dollar supported. Moving to industrial metal complex, base metals except nickel and lead traded on a positive note as stimulus measures announced by China boosted demand optimism. Aluminium benefited from supply tightness concerns as power shortages forced China's Sichuan province to halt its entire aluminium capacity of about 1 million ton. Worsening European energy crisis also supported energy-intensive metals like aluminium and zinc. Nickel prices closed lower on weaker downstream demand, while lead prices declined as some Chinese secondary lead smelters gradually returned to normal production. Going ahead, industrial metals may be pressurized by hawkish comments from Fed Chairman. Also, market players may remain wary ahead of US labor report and manufacturing data from major economies. However, downside in copper might be limited as the world's largest copper producer, Codelco, has cut production outlook for 2022. Besides, aluminum and zinc may also remain supported by Europe's energy crisis. Lastly, talking about energy complex, crude oil noted mixed trade but ended higher, gaining support from Saudi's willingness to consider production cuts to keep global market balanced. China's stimulus measures and hope of higher fuel switching due to rising gas and power prices in Europe and China also lent some support. Weighing on prices were demand concerns, firmness in the US dollar, and correction in US equities. Crude oil may remain volatile as supply risk counter demand concerns, hence one should wait for higher levels to create fresh shorts. Moving to natural gas breached the $10 level for the first time since 2008 but shed all the gains and ended with modest losses. Natural gas came under pressure as Freeport announced that the Texas LNG terminal, shut since June, may reopen in the month of November as against earlier estimate of October. This may further hamper US LNG exports. Also weighing on price was bigger than average rise in stocks and forecast of less severe weather in the US. Natural gas may remain volatile, however, tightness in US and European markets may keep prices supported and close to the $9 level. Well, that's it from my end. I wish you all a very happy trading week. Thank you.